Welcome to Trading World Summit. Do you know that there are actually 3 core drivers to trading success? If you want to learn the 9 accelerators to improve your trading results fast, you definitely have to hang around for this next presentation. Hi, I'm Philip Teo, your host for Trading World Summit, and I'm excited to introduce to you Adrian Reed, our presenter for this session. Adrian is a full-time private trader and also the founder of trading coach at Enlightened Stock Trading, which focuses on educating and supporting traders on their journey to profitable systems trading. Following his successful adoption of systematic trading, which generated hundreds of thousands of dollars a year using just 30 minutes a day to manage his system trading workflow, Adrian made the easy decision to leave his professional work in the corporate world in 2012. Adrian trades long-short across Australian and international stock markets, and his trading systems have consistently outperformed the international stock markets with dramatically reduced risk over the past 18 years. Now, with this short introduction, again, it's my honor to welcome our summit speaker for this session, Adrian Reed. Hey, Adrian, welcome to Trading World Summit.
Hey, Philip, so good to be here. I'm really excited about this summit. It's going to be awesome.
Yes, it's going to be awesome. I'm very sure about that. Now, it's a privilege again to have you on board this summit to share with us your complete model to help a trader accelerate his trading journey or learning curve. Now, for the benefit of those summit participants who might not know you before this, how about have you walk us through on your personal trading journey? How did it start for you, and what were some of the defining moments of your trading career?
Yeah, absolutely. Thank you, Philip. So I've been trading stocks now actively for about 20 years. And that all started probably like a lot of viewers because I didn't want to do what I was doing forever. You know, I wanted to have a career, sure, but I didn't want to have to work like a dog for 30, 40 years like I'd seen my father and others around me do. I wanted to be free. And so when I first started working, I was really looking around for alternatives to build some financial freedom. So I had some options. I had some alternatives to the traditional career path. And so I stumbled across the stock market, and I knew about the stock market because long before when I was a kid, I first came across the stock market by playing a game called the stock market game, which is all based on the Australian stock market. And you know, you rolled the dice and the market went up and the market went down and you bought and sold different stocks and you became a billionaire on paper, and it was amazing. And so I sort of had this idea from when I was a kid that stocks was a good thing. But then fast forward to when I was an adult, I got into it and I found actually it's really not as easy as the game. You know, I started trading and I bought companies that I thought were good companies and they went down and I lost money, and I cashed them out, and then I did more research and I found other companies I thought were good, and then they went down, and so I was just losing money. And I realized that I actually had to learn and educate myself about this. And so the biggest defining moment, I guess, was right at the start when I realized it wasn't just a game. It wasn't just something you can step into with your normal street smarts or, you know, experience from other parts of life. You know, trading is a vocation. It's a career in itself, and you've got to invest in your learning. And so early on, I invested in my learning and I started reading, and I read about 200 books on trading, and particularly focusing on systematic trading, which is what I'm going to get to, and what I do now. And that was really the transformation for me, because a lot of people come to the markets and they just think, oh, I'm smart. You know, I know some stuff. I know some businesses. I'll figure it out. But it's actually, you know, counterintuitive. There's a lot about the market that just is completely different to normal life. And you've got to learn that. And so I doubled down on my learning at the beginning, read, as I said, hundreds of books, studied, and found a method that worked. And after three and a half years of struggle, I implemented my first trading system. And this was the second major turning point for me, because for the first 3.5 years, my equity was up and down, but all the while trending in the wrong direction. And if you look back at my records, you can identify to the day when I put my first system in place, because the nature of my equity completely changed. It was volatile and down, and then all of a sudden it turned a corner and it started rising and started growing consistently. And there was one trade which really just solidified everything for me, which I remember clear as day. I bought this stock. It was, I bought on a breakout. It was a small cap Australian mining company, and I bought on a new trend, and I had a trailing stop in place. I had a stop loss. I had all of the system rules in place, and it just went. And that one trade doubled my account size over the span of several months because it was a monster move. And I was hooked on systematic trading, on following trends. And from then on, that's more or less the way I trade, systematically. So 100% rules-based and following big trends.
I see. So how long did it take you before you decided that, all right, the time has come for me to just quit my job and become a full-time trader?
Well, look, when I started, I was pretty young and I didn't have much money. So that was a ways off when I first started trading. I started trading with $7,500, and that is just nowhere near enough money to live on as a trader. So I traded for many years alongside my work. I mean, I was enjoying my work, but I was also enjoying the fact that I had something that was building wealth and freedom outside my work. So it wasn't for several years before I even started considering quitting, because everything was okay. You know, my trading it's systematic, which means it's very quick, and it was only taking me 20 or 30 minutes a day. So I could do it on the side. I could make money in my career. I could make money in my trading, build wealth, have income. It was all great. Add money into my trading account and grow it. But in 2012, my career was starting to get pretty high pressure. You know, I had a fairly senior management job. I was working 12, 14 hours a day, 5, 6 days a week, and it was a torture year. And at the end of the year, I added up my trading profits, and I looked at my salary and my bonus. It's like, long hours, stress, pain, and no sleep. And I earned $230,000, I think, that year. And in trading, 20, 30 minutes a day, no stress, in my spare time, and I earned more money than that. So at that point, the lifestyle trade-off was no good. So I left the corporate world. I started trading full time, and here we are.
I see. So was it difficult psychologically to actually decide to quit your job and seeing your overall income cut by half? Although you although you get more freedom, but how does that feel to actually dump what you have been building your whole life and drop half of your total income just to go into full-time trading?
Look, it is really tough, and leaving the job to trade full-time is something people shouldn't take lightly. Because one thing the job does that really helps you with is it takes the pressure off your trading. Because while you're earning an income, you can trade and you can focus on trading well. And the dips don't matter so much. There's always dips. There's always drawdowns, right? You can't avoid them. There's always losses. But if you're not 100% relying on it, it's pretty easy. So for me, building my trading capital to the point where trading could provide enough profit that I didn't have to worry too much about the dips and drawdowns was really important. And I used the job to pump some money in early on so I could grow my trading account to that point. And I call it, with my students, I call it the point of no return. It's where the trading account is making more money than what you need, and it will keep growing even if you start drawing out of it to live on.
I see. And usually it will be like really comfortably much more than what you need on a monthly or yearly expenses kind of way, right?
Yeah, personally, I think that's really important because, again, you don't want to put a lot of pressure on your trading. There's a difference, right? There was another important turning point for me, which is the point at which I knew trading would work and would get me free, which is before I was free, right? When my account was growing consistently and I had a process and I hit about $30,000, I remember thinking, it's going to work. I'm going to make it. I'm going to be free, right? I had that realization well before I was free. And having that is critical for the spirit, I think. You know, you get to that point, you've got absolute confidence. There's no question I'm going to become free and independent. Then it's just a matter of time. So I just used that time to trade well, and I pushed my career and I traded in my spare time, and it was all great. I think a big mistake a lot of people make is trying to, you know, they've got a small amount of of money and they're trying to, make an income from trading, it's a really tough thing to do, particularly if you're a new trader. So I think it's far more important to build your account so that you can build massive wealth and then, use that wealth to support yourself.
I see. Wonderful. I'm sure you are now all ready to share your presentation with the summit participants and guide them on what were some of those steps and some of the actions and the key things that you did to get you to that point. Now, to the summit participants watching this video right now, I'm sure you're just as eager as me to seek Adrian's insight. So without further ado, let's sit back and learn from Adrian.
Hi, welcome back. My name's Adrian Reed and I'm the founder of Enlightened Stock Trading. And in this presentation, I'm going to share with you the path to trading success, a complete model to accelerate your trading and improve your results quickly. So let's jump straight in. So first of all, a question: are you new to trading and you want to get started the right way? Or maybe you're already trading and you want to improve your results quickly. If so, you're in the right place. My goal for this presentation is to show you how to get started and how to improve your results using a simple framework that will dramatically accelerate your progress as a trader. Because as a trader, let's face it, there are so many different things that you can focus on. I want to give you the tools or the framework so that you know exactly what to focus on and can eliminate all of the noise so that you can make progress fast. That's my goal for this presentation, so stick around. Okay, first of all, a little bit more about my background, just so you know who you're learning from. My name's Adrian Reed. As I said, I've been a private stock trader for the last 18 plus years. At the beginning of my journey, I really struggled, just like most people, because I was losing money in the markets. And when I decided to make this work, when I decided to make trading my long-term goal and career, I really doubled down on my learning. I read over 200 books on stock trading. I attended multiple courses. I studied and I implemented the systematic approach that I'm going to share parts of with you today. In 2012, after trading for some years, my trading was going so well that I escaped the corporate world after making more money trading just 20, 30 minutes a day than I did in my sort of corporate executive job, working 5-6 days a week, 12 to 14 hours a day. I had an absolute torture of a year in my career, but trading was amazing. And when I looked at my results at the end, it was a very simple decision, because the stress and the pressure and the time of my career just wasn't worth it anymore when I had my trading to the point where I could be free and work just 20, 30 minutes a day. So I stepped out of the corporate world. And since then, I managed through trading to pay off all of my debts, build a 7-figure trading portfolio, buy multiple houses and pay them off with cash. And now I mentor and coach dozens of traders from all over the world to profitability every year through Enlightened Stock Trading. And you're going to be asking probably, well, if you're going so well, if you're so successful, why do you teach? And let me tell you, trading from home with a laptop for 20 to 30 minutes a day sounds like an amazing dream, and it absolutely is. You should go for it. But it only takes 20 or 30 minutes a day to run the style of trading that I run. So I have all of this time to do something productive with. And I like trading. I like to talk trading. I like to share trading ideas. I like to help people with trading. The logical thing is to teach traders how to succeed. And so I've built this trading education business and group to basically have myself surrounded by the people that I want to hang out with, which is great people like you learning to trade profitably. So that's why I'm here. So in this presentation, as I said, this is the path to trading success. You're going to learn the 3 drivers of trading success that you absolutely must have in place. And you're going to learn the 9 trading accelerators to improve your results fast. And I'm going to give you a simple way to prioritize your focus to get the biggest impact on your trading now. No matter where you are, whether you're brand new or whether you've got some experience in the market, how you can improve from where you are to get to your goals faster. Sound good? Great. Okay, cool. Let's get into it. The path to trading success. There's 3 things you absolutely must do if you're going to survive and thrive as a profitable trader. The first thing you have to do is you have to protect your capital. Now, I know this sounds a little bit obvious and you might be rolling your eyes like, oh, I've heard this before. Yeah. But it's absolutely true. Let me ask you this. Let's say you have $10,000 in your trading account. And let's say through some magic or amazing trading calls or some luck, probably luck, you managed to double, triple, quadruple that account in a year. Maybe you used a lot of leverage and you got lucky. And now all of a sudden you've got $50,000 or $100,000 in your trading account. You've had an amazing year. You feel like a champion. And then the following year, you lose it all and you're back to zero. Now, if you're back to zero, the previous year means nothing now. It's all gone. You've lost it. You may as well have not even achieved that. If you don't protect what you've got and what you earn, earning it is pointless. So putting protection in place is absolutely critical for you to succeed long term. And I'm going to share with you exactly how to do that during this presentation. You must, as a first priority, protect your capital. The first priority is not to make money. The first priority has to be to protect, because then if you don't protect, it doesn't matter how much money you make. You'll lose it and you'll be back to square one and you won't achieve the long-term goals. Second key to trading success is you have to systemize. Now, you can trade systematically like I do, which means you have absolute rules, or you can have some discretion in your trading, use technical analysis and other things. But either way, no matter which method you choose to trade, you must have rules that you follow and a process and a systematic approach to the markets. Because if you don't, it's going to be haphazard and random, and you're going to end up with very inconsistent results. Now, I'm going to suggest, and hopefully through this presentation, show you that a systematic trading approach, trading with systems, is the most successful way for new traders to get into the market and profit consistently. We have to systemize. Think about an analogy of a factory, okay? A factory that produces widgets or cars or whatever has processes to produce those products. They follow the same process day in, day out, and they produce the same product to a high level of quality so that they can sell it for a certain price and make profit. Now imagine that same factory decides one day to throw away all the process and just manufacture and build and sell however they felt like that day. The workers come in and say, oh, well, I don't want to be on the production line today. I want to be on the paint line. And the painter comes in and says, well, I don't want to be on the paint line. I want to be in research and development. And the research and development guy says, I might try my hand at, assembly today. It's clearly not going to work. The factory is going to lose money and it's going to be unprofitable. Trading is the same way. If you're jumping from method to method and approach to approach, however the wind takes you each day, it's going to be very hard to be profitable. We've got to systemize our approach. And then the third one is diversify. Now, if you've got a set of trading rules that work, that's great. But one set of trading rules is absolutely not going to work the whole time. There's going to be bull markets, sideways markets, and bear markets. There's going to be volatile. There's going to be quiet markets. There's going to be trend changes and trend changes in the other direction. And so one set of trading rules will probably work in a couple of sets of market conditions. If you want to be consistent, if you want to be stable and really build your wealth through trading, you need to have multiple approaches. You need to diversify in several different ways that I'll share with you in the rest of this presentation so that you can make money more consistently. Now, what happens if you don't do these three things? Let's imagine you protect your account and you systemize your process, but you don't diversify. Okay, you'll survive as a trader, but you're going to have pretty limited growth, right? Limited growth because you're only going to make money when your one system or your one set of rules is in sync with the market, right? But if you have multiple sets of rules that are profitable and back-tested and you have confidence in them, you can unconstrain that and you can start growing and profiting in more market conditions. So if you just protect and systemize, it's not enough. You're not going to make good returns. Now, what if you systemize and diversify, but you fail to protect properly? Well, if that happens, you're going to have inconsistent results and you're going to have multiple occasions where you're going to blow up your trading account. Blow up your account just basically means you lose everything. Because it doesn't matter how good your system is and it doesn't matter how diversified you are, if you're not good at the risk management, at the preservation of capital, something will eventually go wrong that'll blow you up. And that takes you out of the game or way back to the beginning. And it's a terrible spot to be in. I mean, I have been trading 20 odd years now, and I've never blown up a single account because protection was the first thing I focused on. Not massive profits, protection. Because I knew that if I could make good returns then protect them, then my wealth would grow. I didn't have to worry that I was trading recklessly and I could lose everything and have to start again. I've come across so many traders who have saved up a small stake, started trading and lost it all. Then they have to work, save up another small stake, started trading and then lost it all. And then saved up more and then started trading and lost it all. And that wastes years of time. Every time you blow up your account, years. And it's not just time, it's compounding. If you take 5 years to be profitable because you save money, blow up, save money, blow up, save money, blow up, and then figure it out, in 10 or 15 years' time, you're going to be millions of dollars worse off, millions, than you would have if you just learned to protect your capital and grow consistently from the very beginning, because you've got so much more time to compound. Now, what happens if you protect and diversify, but you fail to systemize? Well, you might be profitable, but chances are it's going to be very high stress and a lot of effort. The systemization piece makes trading quick and easy and repeatable. It tells you exactly what to do each day, each trade. So you don't have to think about it, you don't have to analyze it, you don't have to write individual plans for every single trade. Systemizing takes away the stress and the effort, it makes it easy. So if you don't protect, systemize, and diversify, you're gonna be cursed with one of these three problems, either limited growth, inconsistent results or blow up, or high stress and effort, or probably some combination of all three. But if you do this well, what happens? Well, you get high reward, low effort trading, right? Because you know you're not gonna blow up, you're gonna trade consistently because you're systemized, and you're gonna make money in many different market conditions because you're diversified. And this is exactly what we want. If you want to grow your wealth and become a full-time trader supporting yourself, you need to do these three things. Now, let's dig into what these actually mean at a deeper level. What are the accelerators that get you there? If we do these three things, that's great. But around these, there's 9 accelerators that I'll go through now, 3 for each section. So under protect, you've got to do 3 things. The first thing you've got to do is have a daily process that you follow. I have the same routine that I focus for my trading every single day. What that means is I don't skip, I don't miss steps, I don't forget to do things, I don't take different trades in different ways. I just wake up, I follow my process, then I close my computer and my trading is done. You've got to have a process you follow. Imagine an airline pilot. I don't know if you've ever seen the cockpit door in an airplane open when you walk onto the airplane. Usually if it's open, the pilot's in there and he's got his checklist of all of the pre-flight checks that he's going to go through. If the pilot didn't do that, there's a much higher risk of something going wrong. You know, plane crashing, people dying, you know, emergency landings, all of that stuff. We want to avoid that with our trading. Have a daily trading process. Secondly, manage your risk. You got to manage risk at multiple levels. And I'll get into this in a little bit more detail later on. And then thirdly, we've got to eliminate our trading mistakes. Now, I've come across traders who have had amazing systems, great rules, hugely profitable systems, but they're losing money overall. Why? Because they make so many mistakes in executing those systems that the expectancy is completely eroded and they end up losing money. Now, there's a small number of trading mistakes that most traders make, which you can eliminate. And I'm going to share those with you today so that you can eliminate them and start making more money immediately. So I hope that sounds good. Now, that's protect. To systemize properly, you need to do 3 things. The first one is have objective rules. Objective rules just means rules that are absolute. You don't have to second guess them. You don't have to judge them. You don't have to squint your eyes at the chart and say, okay, well, is this one of these patterns? And, you know, should I go long or short here? No. It's if this and this and this is true, I buy. If this or this happens, I sell. It's absolutely objective. The great thing about that is it removes all the emotion from the game. And when you remove the emotion from the game and you know exactly what you can do, what you have to do, guess what? You can be consistent. But objective rules is only part of the problem. You also need to master backtesting. Now, once you've got objective rules that are absolute and logic-based, if this and this and this is true, I buy. If this or this happens, I sell. You can then backtest them. Backtest them means over all of the past data from the markets over the last 20 or 30 years, over all of the stocks in the market, test those rules and see how well they work. Master backtesting and you master trading confidence because you know what's going to happen. You know, not what's going to happen in the future, but you know what's going to happen by following these rules. You know, okay, I'm going to make sort of this much money. I'm going to have this sort of drawdown. I've got this much volatility in my account because you can backtest it and see how that performs. And then thirdly, once you've backtested your trading systems, you've got to monitor and improve them. You know, it's no good just to put a system in place and then close your eyes and keep trading it day after day, buy, sell, buy, sell. You've got to actually monitor that and come up with ideas to improve it. And those ideas feed back into your backtesting so that you can make the system better, make more money. And then finally, diversify. 3 accelerators to diversify your account. You want to diversify in multiple different ways. Diversify different strategies or systems, right? Maybe you have a trend following, maybe you have a mean reversion, maybe you have a short selling, maybe you have a swing trading. If you just have 3 different trend following systems, it's not very diversified. Different strategies. You also want to diversify markets. If you're trading American stocks and that's all you ever trade, you're sort of at the mercy of the American stock market. Similarly, if you only trade Singapore, if you only trade Australia. One of the biggest levers of performance for me was diversifying offshore out of my home market, because all of a sudden I was able to profit from markets that were moving in completely different ways. You know, this might also mean going from stocks to crypto, or from stocks to futures, or from futures to stocks, or from crypto to stocks. So you want to trade multiple different markets and asset classes so that you can make money in more market conditions. And then thirdly and finally, timeframes. You know, a lot of people will say, well, I trade the 4-hour chart and that's the way I trade. It's like, well, why? Why just trade one time frame? You can trade daily charts and you can make money. You can trade weekly charts. You can trade 5-minute charts. You've just got to have a method that works. Think diversification in multiple different dimensions: strategies, markets, timeframes, and you can improve your trading dramatically. So this is the path to trading success. You got to protect, systemize, diversify, and then put these 9 accelerators in place and gradually build on them and strengthen them. And you'll find that your trading dramatically and quickly improves. So what does this look like for your trading? With some practical examples, how can you implement this framework to improve your results? Okay, let's go through each of the accelerators and talk about them. Daily trading process. Here's my daily trading process. It's dead simple because I'm 100% systemized. This is all I have to do. In the morning, I update my data for the previous day. The software, the downloader software does that automatically. Then I open my trading software. I use Amy Broker. There's many other charting platforms around that you can do it. I check my existing positions to see if I've got any exit signals. Then I run a scan or a backtest to find new buy signals. And then I place the buys and sells with my broker. And then if I've got any thoughts or issues that I need to work on in my trading diary, then I do that. Total time, 30 minutes maximum. This is what I do every day. And I trade multiple systems across multiple markets, and it only takes 20 or 30 minutes because it's all systemized. All of the scanning, all of the checking for exits, all of that is done by the software, and it's pretty quick and simple, and it's repeatable. Same thing every day. So if you're finding that you're approaching your trading in a different way each day and not quite, you don't have a routine, putting a routine in place is the first step for you. Okay, how do you practically manage your risk? Well, you can manage your risk. There's 3 things that I want you to think about: trading system performance, how good are your rules, stock-specific risk, and market risk. Okay, let's talk about trading system performance first. You want to start by understanding the return and the drawdown of your trading rules, and do that by backtesting the trading rules. You'll come to backtesting mastery later on in the presentation. But if you are trading rules that you have not backtested, that means you don't really understand how much money you're going to make, how big the drawdowns could get, how much volatility there's going to be in your account. You've got to start by understanding those things and make sure that you're comfortable with the results. So understand your system's performance by backtesting on past data, improve the performance by optimizing the trading rules and testing new ideas, and above all else, make sure you position size your trades so that the drawdown that your rules generates is tolerable for you. I might be able to tolerate a 25 or a 30% drawdown, but if you're freaking out at 15% and you want to dump all your positions because you've lost too much money, you need to position size differently to what I do. So you've got to think about your drawdown objectives, your tolerance, and make sure that you position size so that the drawdown is within your comfort zone. And the way you do that, again, is by backtesting different position sizes and see, okay, where is the risk return profile that you're comfortable with? That's trading system performance. You want to make sure that you're comfortable with the return and the drawdown side. You can't just get dollar signs in your eyes and forget about the drawdown, because believe me, when you've got a big account and it starts to fluctuate, it can get stressful if you're not comfortable. Okay, stock specific risk is the second way that you've got to manage your risk. And you manage stock-specific risk by low and consistent position sizing. Now, I've got this diagram here that explains how you size your positions to keep your risk at 1% per trade based on your entry price and stop loss. I'm not sure I want to go into all of the detail of that right now, but the calculation is there. The message, which is the most important message probably of the whole presentation, is you've got to make sure that your position sizing is low, small positions, and consistent across trades. Because what a lot of new traders do is have more confidence in one stock or one trade than another. And so they load up more on one than another. But in fact, it's really just some sort of emotional baggage or connection that's that you've had previously, or some feeling you've got that is based on something unrelated that's causing you to have more confidence in one trade than another. The best way to stabilize your trading is to stabilize your position size and your risk per trade. Maximum 1% risk on each trade. 1% risk means if you're wrong and it hits your stop loss, you should only lose 1% of your account. I actually risk much less than that in most of my systems, typically around 0.5%. So whatever loss you have on your trading, have a look at it, figure it out as a percentage of your total capital. And if it's more than 1%, you're sizing too big and you should shrink your trade so you can be more consistent. But you've got to do more than just think about the loss if your stock hits the stop loss. You've got to think about the extreme scenarios. What happens if a stock I'm holding goes bankrupt and delists overnight? How much money will I lose? Now you're like, yeah, okay, how often is that going to happen? Well, I've been trading for 20 years and I've taken thousands of trades and it's happened to me 4 times. 4 times out of several thousand trades. Now, it doesn't sound like much, but if you have too much of your capital tied up in one stock and for some reason something happens like a corporate fraud, like what most of them were, then you lose, you take a big hit to your account, you have a big drawdown, and it takes a lot of time and energy and emotional trauma to recover. So when you're calculating your exposure on each trade, how much value of stock you're buying, you're going to make sure you keep that number small. Think to yourself, if I had a total loss on this, I know it's unlikely, but if I did have a total loss, what percentage of my account would I lose, and am I comfortable with that? And if you can answer that, yes, I'm comfortable, and no, it won't take me out of the game, then you're doing okay. But I've seen traders that have 25, 30, 40% of their account exposed to one stock. And they might say, yeah, but I've got a stop loss. It's like, well, but what if it gaps through the stop loss? You've got to control your risk, your normal everyday risk with your stop loss and your position size, and your catastrophic risk with your exposure, your total exposure. 5 to 10% max is a good guide. The smaller, the better, because it's more likely to keep you alive. Okay, here's how most people trade. Long only, they buy and hold, they borrow lots of money, they use leverage, they ignore their stop loss, they ignore their exit signals because they think the market will bounce back, and they buy more and more of the stock when the market declines so they can reduce their average price. Okay? These are traits of most new traders. Now, if you've done any of those recently, then here's the thing, and I hate to be blunt, but you're being delusional about your trading. Because long side only assumes the market only goes up. It doesn't. Have a look at COVID back in 2020. The market definitely goes down. Buy and hold assumes that stocks will always go up and that the drawdowns are going to be tolerable, but they're not. You can have a 50, 60% drawdown with a buy and hold strategy, and that's pretty painful. So some of these things you really want to, pardon me, some of these things you really got to take a long, hard look at. To manage your market risk, you've got to trade differently. You've got to do something different to what most people do, long and short. Use positive expectancy trading systems. Trade with money you can afford to lose. Stick to your stop loss. Close every trade when it gives you an exit signal. And never add to a losing trade. This delusion of, I bought it at 10, now it's 5. If I double my position size, I've lowered my average cost. So when it goes up to 750, I can make money. Averaging down is complete bollocks. What you've done is you've got one terrible trade and you're taking another trade hoping to disguise the fact that you made a first terrible trade. Never add to a losing position. If it hits your stop loss, you're out. That's it. Because we don't need to make money on every single trade. What we need is a process that generates good trades over time and has a positive expectancy. We got to lose the detachment to each individual trade and follow the process. The process makes money. That's the beauty of systematic trading. Now, I said to you that there's a couple of mistakes that hold most traders back. Actually, 2 I really wanted to highlight. The first one is taking profits too quickly rather than letting them grow. Now, let's face it, when we take a trade and we're new in the markets and it goes in our favor, it's like, make money, yeah, I want to bank my profits, right? So you take the profits, like, yes, I'm a winner, right? But taking your profits too quickly is an absolute killer for your profitability. Here's what happens. Let's say you've got this trading strategy and it produces a series of wins and losses. Now, on this chart here, on this image, the solid box above the line where the green is up here, that's the trade potential. But let's say it was going to be a good trade. You started to make money, but you just thought, oh, you know what? I'm just going to take a quick profit on this trade. Have you ever said that to yourself? Or maybe, hey, this stock looks like it's topping. I think I better bank my profits now. Or, you know, the market's getting a bit volatile. I might take my profits down just in case. Or maybe, you know, last time, maybe you said to yourself, last time I held onto this stock too long, I lost money. So I'm going to take my profits and get out so that doesn't happen again. And then finally, you know what? I want to buy a new car. I think I'm just going to bank my profits now and go shopping, right? If you say any of these things to yourself, you're cutting off the profitability of your trading approach because you're trimming all of the winning trades. And then what happens? The winning trades aren't big enough to overcome the losses. You've got to let your profits run and get big. This is why trend following is my favorite strategy, because it allows your profits to grow and grow and grow so that the big winners offset the small losses. If you find yourself tempted to snatch profits off the table quickly, that's probably why you're not profitable yet. The second big mistake that holds traders back is holding on to losing trades, hoping that they'll turn around. Now, I don't know how many times I've heard someone say, yeah, I've turned this into a long-term hold. I'm just waiting to get back to even, and then I'll sell it. Like, that could take years or never. So if you've got a trade that hit its stop loss or gave you an exit signal, whoosh, you've got to cut it. Because here's what happens if you don't. Your losers get big. And you're going to be tempted to hold on to them because you want to be right. We all want to be right. It's a human thing. But if you hold on to a losing trade, chances are it's going to get bigger. Your loss will get bigger. And then the losses will be so big that the wins won't be big enough to overcome the losses and grow your account. Again, we're going to decouple ourselves or detach ourselves from the individual trade outcome and think instead about the process of trading well. I follow my rules. I buy when I'm supposed to buy. I sell when I'm supposed to sell. That will produce a series of trades, some wins, some losses, but they will add up to profit in my account. But if I start breaking those rules and banking my profits early, getting small wins and letting my losses run because I want to be right and I'm waiting for them to turn around, then the winners and losses are going to combine into overall losses and wealth destruction. So eliminate these two things. Let your profits grow and cut your losing trades fast. I know it's common advice, but it's not common practice. So if you're not profitable, again, look at these two things and be honest with yourself. Are you really closing your losing trades as soon as you're meant to? Are you really waiting for your exit signal, or you're snatching a quick profit? Okay. Having objective rules, the next accelerator, is the key to systemizing your trading. If your rules are nebulous, like, oh, sort of when this happens and sort of when that happens, and when I get this feeling, I'm going to buy, or when I get advice from over there and the chart all and moving averages all converge, then I'm going to buy. Those sorts of trading decisions are subjective and they can't be tested. But if you make your trading rules objective, which is if A and B and C is true, you buy. If D or E is true, you sell. More logic-based, then you can backtest it. It eliminates the overwhelm of making all your trading decisions. Now, early on when I started trading and I wasn't systematic, I didn't have objective rules. I was spending 3 or 4 hours a night, every night, looking at charts, reading research, investigating the companies, trying to come up with stocks to buy and sell, and timing of when to buy and sell. And it was completely overwhelming and debilitating. I was spending 3 or 4 hours a night and I wasn't getting anywhere and I wasn't making money. But as soon as I put rules in place and went systematic, the amount of time I was spending shrunk from 4 hours to 30 minutes or less, and my profitability went way up. So objective rules. What does that look like? Well, here's a really simple example, okay? The setup for the trade might be the closing price is above the 50-day moving average and the 200-day moving average. It's trending up. The entry trigger might be the stock makes a new 200-day high after a pullback, so it breaks out. The initial stop loss, a 2 to 4 ATR, average true range ATR stop loss, and then a 25% trailing stop to allow the profits to run and lock them in as the stock price goes up. And then you sell if the price drops and hits the 25% trailing stop. If you trade like this, it's 100% objective. There's no doubt whether the closing price is above the 50 and the 200-day moving average. There's no doubt that it made a 200-day breakout. There's no doubt that it hit the 25% trailing stop. It eliminates all the subjectivity and all of the overwhelm and all of the need to look at multiple different sources of information. Systematic, objective trading decisions is a lifesaver for private traders. Now, once you've got that, backtesting then becomes your most useful skill. Because what you can do with backtesting is you take your objective rules, you combine them with the past historical data of all of the stocks on the market, and you run a backtest that says, if I'd have followed these rules every day for the last 30 years or so, what would my portfolio have looked like? Now, I can't tell you how many times people have given me their trading rules and I've put them into a system, coded them and backtested it, and the rules didn't make money. I also can't tell you how many times I've read a trading book, taken a set of rules out of it, put it into code, backtested it myself, and the rules from the trading book weren't profitable. It happens all the time, particularly when people don't take into account slippage and commissions and how markets change and all of these things. You've got to backtest your rules. Otherwise, you're flying completely blind and you're just operating on blind faith with your finances that it's going to work. And if it didn't make money in the past, what's the chance of it actually making money in the future? Pretty much zero. So you've got to check that your rules actually made money. Backtesting is your most useful skill. If you haven't yet started doing this, this is a huge leap forward in your ability to profit consistently and be confident. Now, I'm not talking about looking at some charts and finding some signals. I'm talking about putting the rules into some trading software and testing over 20 or 30 years over several thousand stocks, generating thousands of trades in your database and producing this equity curve like we've got here on the right-hand side. That's what you got to do, because that's what's going to give you the confidence the rules actually work. Once you've got your backtested rules in place and you understand them and you're confident in them, then it's time to monitor and improve. As you're trading day by day, week by week, you monitor the equity curve, you monitor your drawdown, monitor your percentage of winners, your average win, your average loss, all of the trade statistics, and check that they are stable. Make sure the market hasn't shifted, that there's no problem with your systems, and look at the trades your system is generating to come up with new ideas to make it better. And if you get a new idea, you throw it into your backtester, you try it out, you see if it makes your system better or worse. If it makes it better, you can keep it. If it makes it worse, you can throw it away. But you can't afford to trade with your eyes closed. You've got to be watching the performance stats and monitoring and measuring to make sure that everything is working smoothly. As soon as you start closing your eyes and blindly following a process, something bad's going to happen. You lose a lot of money. Okay, now we're on to diversify. The 3 accelerators to diversify. The first is strategies. Most people will start trading with just one strategy, which is great, better than no strategy. But one strategy will not work in all the different market conditions. Markets can be bull, sideways, or bear. And if they're in a bull market, the trend can continue. There can be shocks against the trend, or there can be a change of trend. This is my model. I call it the market system map, which talks about all the different behaviors the market can exhibit. So if you look at these 3 by 3, there's 9 combinations, 9 behaviors the market can exhibit. And you want to tick off as many of those as you can to say, yep, I've got rules that make money in each of these boxes, or at least many of them. If you've only got one box you can tick where you can make money, it's time to diversify. You need some different systems and different strategies to help you diversify. You also want to trade multiple markets. Like I said earlier, if you're just trading US stocks, think about overseas stocks, think about crypto, think about Bitcoin, altcoins, futures, Forex. Start diversifying your asset classes, because that's going to help you make money in more market conditions. I've got trend following in crypto, and I've got trend following in stocks. And let me tell you, having the combination of the two is amazing, right? Crypto is going down right now as of the time we're recording, so I'm in cash in that front. But on the stock side, I'm in money, I'm invested, and I'm making money on the long side in the stocks. And that's going to change around at some point as well. So having money in different markets is a really powerful way to do it. And you can systematically trade all of these markets. And in fact, you know, if you're trading crypto now and you're not systematic, I can guarantee you are gambling and you're leaving money on the table, because a simple set of systems in the crypto markets makes an astronomically strong return. But you got to systemize, have objective rules that are backtested so you can follow them, just like we said earlier in the other accelerators. And then finally, timeframes. Again, most people will say, oh, I trade the H4, or I trade D1, or I trade weekly charts. Don't just stick to one. Start with one where you can make money and then diversify, spread your wings. Most people tend to start down here at the really short-term end because they think that reduces their risk because they're trading very short-term. In fact, the daily charts is probably the easiest to make money on. And after daily, I would go to weekly, because I've got some weekly systems which are just astronomically good. You know, 20, 30 minutes a week, and they're making high double-digit returns with very controlled drawdown. And then if you can trade profitably on those, think about going shorter term. Most people do it the other way around, start short term. I really think starting on daily charts is the best way to go for most people, because most people have a job. And if you've got a job, you can't trade short-term charts unless you're fully automated. And there's a whole bunch of complexity around automation that I think is a real challenge if you're new to trading. Start on dailies, you can do it manually, and then go to weekly and then come back. And that will really serve you well. So this framework gives you a complete path to trading success. Right? Protect, systemize, diversify, and follow these 9 accelerators. And whichever one you're missing, whichever one is holding you back, that's where you need to focus. Now, if you're new, what should you do? Well, you want to figure out where you should focus first. If you're just trading the market and you don't really have any of this in place, you've got to start at protect, put a daily trade process in place, manage your risk, and start eliminating your trading mistakes. Then you systemize, learn to backtest, and monitor and improve that, and then diversify. So this is actually a process, more sort of like a wheel, where you start at the blue and work your way around. If you're already established in your trading, look at this framework and rate yourself out of 10, where 1 is you don't do this at all, and 10 is you're a world-class expert and you could teach it. Rate each of these different accelerators, the 9 accelerators, and figure out where you're weak, and that's where you should focus your learning. So that's how you identify where you should go next to improve your trading. So look, there's a lot in this. There's a lot to consider, and trading is, you know, it's simple, but there's a lot to learn to get started. And you probably feel like you're drinking out of a fire hose right now. There's been a lot thrown at you, 9 different accelerators, 3 things you've got to do to get right, and all of those examples. So how would you like a simple way to take a big step forward from here, no matter how you're trading? What I want to help you with is some free resources to accelerate your trading journey. The most common things that you need to really take a big leap forward. And I've put together a bundle of these to really help you so that you can take a big leap forward very quickly and improve your trading right now. And that's what I want to offer you as a result of attending this presentation, to thank you for being part of the summit and part of my presentation. So the first thing you're going to get is a daily trading process cheat sheet to show you the steps to follow each day to make sure that you don't miss anything and you get consistency into your trading. The second thing you're going to get is a trading mistakes cheat sheet and worksheet to identify and help you eliminate the mistakes you're making. Because it doesn't matter how good your rules are, if you make too many mistakes, you're going to lose money. And this is the quickest way to turn your trading around, to identify the mistakes you didn't realize you were making. And so the trading mistakes cheat sheet is going to help you do that. In about 5 or 10 minutes, you'll probably identify a handful of mistakes, probably a dozen mistakes you're making that you can quickly eliminate or address and turn your trading around. Huge value, very little effort for you. Next, I'm going to share with you an example trading system, both the rules and the code, so that you can see, okay, what do objective systematic trading rules really look like? So I'm going to give you a trading system with the rules, with the code, so that if you've got, you know, when you get the right software, you can backtest it. And you can look at those and see, okay, this is what a complete set of rules looks like. And then you can compare it to what you've already got. You'll see mine is probably a lot simpler, but also more complete. and it controls your risk and keeps everything tight so that you can be consistent. So you're going to get an example trading system. You're also going to get a trading system template and code library. So if you've got your own rules, you can cut and paste your different rules into the template and backtest it and see if it works. So I'm going to give you a trading system template and code library. And I've got a 25-page ebook. I've got the draft right here, which I'm pretty excited about sharing, on how to build confidence in your trading system. And if you follow the steps in that ebook, you're going to be close to world-class in your trading and your ability to be confident in the market. And then finally, you're going to get the Millionaire Trader Code online course, which is going to show you the path from where you are now to being a millionaire system trader. The stages, the 8 stages of evolution and the steps you go through and how to skip steps to get there even faster. So you're going to get the daily trading process cheat sheet, the trading mistakes cheat sheet and workbook. You're going to get the example trading system and code, the trading system template and code library, and the Millionaire Trader, the ebook to build your trading confidence, and the Millionaire Trader Code online course, all for free, just by going to go.enlightenedstocktraining.com/trader-acceleration-bundle. And Philip's going to place the link to this underneath the video so you can get access to that right away. So you can either write that down or click the link, grab the free resources, and accelerate your trading journey. I wish you all the best. Thank you so much for being part of the Trading Summit this year, and safe trading and profits in the market is what I wish for you. I hope this helps. My name's Adrian Reed, founder of Enlightened Stock Trading. Bye for now.
Hey, Adrian, that was a really very insightful presentation as always. And I'm sure the summit participants now have a better understanding of how to actually focus on some of the key areas to accelerate their journey as a budding trader, or even as a trader who used to be discretionary and probably looking at becoming more systematic. Now, to help the participants clarify some of those points you brought out earlier on, shall we head into the Q&A segment now?
Yeah, sounds great. I'm ready.
All right, fantastic. So I just want you to actually share a little bit about systems trading from a bigger picture angle. Well, all that you have mentioned earlier on seems like it makes trading so easy, it's so effortless, and it seems like it's a free way or a very easy way to make a lot of money over time. But I'm sure the reality is not as simple as that. So can you share about some of the difficulties or the potential issues a systematic trader will encounter that would still be something that they will need to overcome in order to actually reach the current stage that you are in right now?
Yeah, absolutely. Really, really good question, because it's tempting to think that trading can be and should be easy, right? But the reality is it's not. There's a lot to it, and most people struggle with it until they really have that epiphany that helps them figure it out. Systematic trading, once you have mastered it, day to day is very simple, because all we have to do is we have our rules, we scan the market for our buys, we check for sells, we place the orders, and that's it. But the trouble is, to get to that point, you've got some work to do, because you have to have rules. You have to have confidence in those rules. You have to have allocated your capital in a way that protects you and diversifies you appropriately and everything. And you have to be willing to keep following those rules when the market is good and when the market is not good. So the way I think about it is this: if you're a discretionary trader, the amount of effort you have to put in to think about each trade is generally high. You've got to find the trade. You've got to analyze the chart. You've got to look at the stock. You've got to take everything into account. When you're a systematic trader, the amount of effort you have to put into each trade is close to zero, very little. But to get started as a discretionary trader, not to get started well, just to get started, you might read a few articles, you might, look at a few reports, you might get a recommendation from a broker, and you place a trade. Easy to get started, harder per trade. Systematic trading, to get started, takes more work. You have to have a system. You've got to learn to backtest. You've got to learn to position size appropriately. You've got to diversify. That takes some work up front, so it's easy later. So systematic trading, effort up front, easy later, and ongoing. Discretionary trading, easier to get started, less work, easier to get started, but harder on each individual decision. So it's a trade-off, right? But if you think about a 20-year trading career, if I'd have had to analyze every stock that I've ever bought, looked at every single chart, checked every single annual report, read all of the advice, read all of the brokers, looked at all the chart patterns to make all of those thousands of decisions that I would make, I'd be about 170 years old to have made the number of trades I've made. But with a systematic approach, the ongoing implementation is pretty straightforward as long as you do the work up front. So you can fit a lot more diversification and a lot more trades into your time. Now, I think the challenges are you've got to learn a new skill. Now, I say coding, and people go, I'm not a coder. It's like, no, I'm not a coder either. I'm a trader. But sometimes you've got to learn a skill to become the thing you want to become. And so, coding is not as hard as we general people think. It's not some mystical, rocket science skill. It's kind of just like simple formulas in a spreadsheet. Greater than, less than, equal to, this greater than that, this and that. It's just logic. And if you have to learn that. That scares a lot of people. But I'm telling you, don't be scared of it. It is, you don't have to be a master coder. You have to be enough to be able to trade and master it. So you've got to master that new skill. You've got to understand the analytics of backtesting.
I see. All right. So I want to ask you with regards to one part of your main factor you were talking about, the systemizing the entire workflow thing. So there's this part, there's one of the accelerator about monitor and improve. So that is the part which I personally feel that it can be rather ambiguous. So can you provide an example or a case study how you actually go about monitoring and improving in your systems trading previously, and what were some of the factors that can really quantify and measure it before you know whether to improve or to stop or to do something else with the system that you are trading?
Yeah, solid question. And you're absolutely right. It is probably one of the more ambiguous, difficult aspects of systematic trading. Great example was 2020 at the beginning when COVID came out, right? The market, basically, most stock markets were at an all-time high. And from an all-time high, they turned around and went straight down. Okay? Understandable in hindsight based on what was going on. But the markets had never gone from an all-time high straight down with no rallies. Just hadn't happened, right? At least not the stock markets, not the ones that I trade. And so I have a couple of systems that suffered a little bit more than I would have liked because that change in trend was far quicker than what I had seen in the past. So when I observed that, I looked at what happened in the market and I looked at my performance and I thought, okay, well, the drawdown is bigger in this system than it should have been. But is the system broken, or does it just need to take into account this new information that the market can go from an all-time high straight into a bear market? And the system was performing as it should, given what was going on. But what I realized was if I made a small change to some of the exit rules, I could reduce the drawdown in an extreme event like that. So in that case, I came up with the idea, I put it into the system, backtested it, found that it did indeed reduce the drawdown and didn't reduce profitability too much from other bear markets. So made that change to the system and then kept trading.
I see. And the subsequent rebound after that sharp fall was also very sharp. So how did you actually handle that in your system? So it's like trying to factor for the very sharp plunge and then the very sharp recovery that didn't really consolidate or didn't really actually slow down. Was that a very difficult phase for you as a system trader during that time last year?
Yeah, look, one of the challenges about systematic trading is you've got to trade when your systems trade. So if you have a system that profits from a sharp rebound, great, you'll profit and you'll trade. But if you have a system that waits for a strong confirmation that the trend has changed, guess what? You're going to wait. So probably psychologically, the biggest challenge for systematic traders is you've got to follow the system. There's going to be this temptation to look at the market and say, well, it's clearly a V bottom. I should get in here. But if you don't have rules that get you in there, you've got no business trading there, because then it's just all the systematic is out the window and you're purely discretionary again. So the lesson is to keep building different types of systems that profit from different types of behavior and add them to your portfolio. So over time, through all of this experience, we get better and better and better portfolios of systems.
I see, I see. So does that mean that when you have a diversification of systems, you are actually trading all the different types of systems at the same time? Or are you actually switching from one system to another as you see the market conditions change? So is it more of a like training all together at the same time and let the negative aspect of each system cancel each other out, or is it switching the system as and when you see a need to?
Yeah, it's a little bit of both. The most important thing is the switching is not a discretionary judgment call. The most important thing is that the system has rules that allow it to trade or take it to cash. So let's say, alongside trend following, you might only take a buy signal when the index is above a 50-day moving average, just to take an example, right? That would keep you out of false breakouts in a bear market, okay? Probably a sensible rule. We're not going to manually think, oh, the index is going up, I'm going to turn on my trend following system. All you do is you just run all of your systems and they have all of those rules built into them. And it'll give you a buy signal if the market is in the state that that system is allowed to trade in. So that system may be trading on the same day as many other systems you've got. Or many other systems might be turned off and that might be the only one you're trading. But that switching around happens just because the systems have rules that turn them on and off.
I see, I see. So does that mean that you actually have a way, let's say, for example, I'm just trying to imagine, you have multiple systems, maybe like trading multiple time frame or multiple strategies. And probably one way you can do is you can actually systemize your analysis of, let's say, the broad market, and how the broad market depends will systematically tell you which systems to turn off and turn on. Is that something that you do as well?
Well, that is what's basically built into the systems. So let's say, okay, I have a trend following system that should trade when the index is above the long-term moving average. And I have a short momentum system that should trade when the index breaks through the 200-day moving average. And I have a mean reversion system that trades anytime as long as the stock is sufficiently oversold. Those rules are like that market analysis that you talked about. They've all got a piece of it. This system will turn on when that market condition is in place. This system will turn on when those market conditions are in place. And this one will only turn on when this specific thing happens. It's all part of the rules. So we don't have to think about it as a systematic trader. All we do is we design the rules and we put those filters in place and we backtest them and say, okay, the risk return profile of this system in the backtest looks good. I'm willing to add it to my portfolio. And then you just run the rules each day. And that's very, very quick to say, is this system signaling or not?
Ah, okay. So is it difficult to actually have a system strategy that actually takes into consideration two instruments? Let's say, for example, I would just be imagining if I want to do intraday trading, obviously the volatility of a stock or the instrument that I'm looking at has got to be pretty high, right? So is it possible, like, for example, I create a rule to say, use this day trading system only if the volatility of the broad market is high. Then you consider taking this.
Yes.
So it's like a layering of systems, right?
Yeah. So again, this will be part of the rule. So let me give you an example. With mean reversion, so you buy a dip expecting a bounce back. Mean reversion works best on high volatility stocks because the moves are bigger and you expect the price to bounce around because it's high volatility. So in a mean reversion system, you would typically have a rule that says only buy if the volatility of the stock is above a certain level. And for a trend following system, it's actually the reverse. Stocks which are low volatility tend to trend better because they don't have big sharp pullbacks, and you buy it and it kind of moves up smoothly and it goes down slowly and hits the trailing stop. So you would have a filter in your trend following system to only select low volatility stocks. You might have a rule that says only trade mean reversion if the market is volatile. You could add that to the system and see if it helps it or not. I don't actually use that rule. It might help, it might not. But if you did put it into your backtest and it did make it better, you would make it part of the rules. And then every day when you press explore or scan or whatever it is to find the trade signals, it'll test that rule as well as all of the individual buy rules against the stock. And if all of those rules are met, it'll give you the signals that you should take.
I see. That's great advice over there. All right, so I want to move on to the part where you mentioned about protect and risk management. So you suggested a general 1% risk to take. And you also mentioned that there are occasions where you actually start with a much lower risk, like 0.5% or maybe even less than 0.5%. So what are some of the occasions that you might actually vary this percentage risk that you take for your trades? Is it entirely systematic as well, or is it discretionary? And if it's systematic, what are some of the factors that will make you change that percentage level?
Yeah, good question. One of the biggest thing that traps traders is thinking this trade is better than that trade. If you imagine you think for some reason this trade is better than that trade, the natural inclination is to put more money, bigger size on that trade. If you're wrong, then you're going to lose more than if you'd have just followed the rule. Now, if we come back to the general principle, protect first, profit second, we've got to make sure we don't have big losses. So you're going to have a consistent position size across all trades in a system. Now, one system might meet your objectives with a risk per trade of 0.5% risk. Another system, completely different style, may meet your objectives with a 1% risk per trade. So it's more system-based than trade-by-trade based. So when I'm adding a system to my portfolio, I look at the position size and I basically optimize the position size to make sure that the backtest results of the system meet my objectives and improve my portfolio. So it's not this trade is better than that trade, I'm going to risk more. It's more like this system performs best with that level of risk. This system performs best with that level of risk. And then at the macro level, back to the monitor and improve. If a system starts getting more volatile or the drawdown is bigger than you're comfortable with, that's when at a system level, you might say, you know what, I'm going to reduce the risk on this system because it's more out of sync with the market. It's getting more volatile. So then you'll do it across the board from then on.
I see. All right, so I want to ask you some questions beyond the scope of what you have just mentioned in the presentation, namely, especially with regards to the execution of the trades in terms of like backtesting and stuff like that. So is reliability of historical data very important? And so how do you also handle like historical events like dividend payouts, bonus issues, stock splits? Do you actually adjust for them in your historical data before you actually do backtesting on them? And where is a good source to find reliable historical data?
The answer is yes, it's important. So there was a few issues in there. So there's stock splits, there's capital sort of reconstructions, there's dividends, and all of those things. Having a good data set that is clean, no bad ticks, is adjusted for stock splits or consolidations is critical. Because if let's say you got free data and it wasn't adjusted for stock splits, there's big discontinuities because let's say the stock was at 100, it had a 10-for-1 split, now it's at 10. It's going to look like you had a loss, but it was just a stock split. So you've got to have back adjusted data to smooth the stock splits. Most of the data providers do that. So if you pay for data, you'll get split adjusted data. You can take into account dividends, but in my view, not essential because dividends are typically a small proportion of the profits compared to the capital gains. So if you want to backtest completely and understand exactly what happens, then yeah, okay, get a data source that has dividends and you can have a dividend adjusted price series. which means they do a back adjustment in the share price whenever there's a dividend to adjust the value of the shares to take into account the dividend they paid. I don't generally do that. I don't think it's that important, because if my system makes enough money to meet my objectives, excluding dividends, then with dividends is going to be what? Even better.
Mm.
So you need a good data source. Definitely pay for data. Don't get it free. If you're going to trade, so the best data source, if you're going to trade Australia or the US markets on daily charts, the best data source is Norgate data. They have the cleanest database. They've got all the delisted stocks. They've got all the historically accurate constituents of the indices and all of that. It's clean, good quality. It's just it's pricey, but it's worth it. If you want to trade other markets, all of that delisted stock and not the split adjustment, the delisted stocks and the index constituents is not really available. So for the rest of the markets, I use Metastock data. Metastock is a very cheap, reliable data source that covers basically every stock market in the world. So you can get every price for every stock going back since listing for about $30 a month.
I see. All right. So another question with regards to execution wise is the type of trading platform or the brokers that you use as a system trader important? What are some of the key factors you might want to think about, or a trader might want to think about, considering that many of our summit participants come from all different parts of the world? They might not have access to the broker or the trading platform that you use. So what are some of the criteria you actually look at to actually go about selecting your trading platform and your broker?
Yeah, I think when you choose a broker, the most important thing is that you're confident that your money is safe. Back to protect, right? The first thing. Because if you choose some dodgy broker in Cyprus because they have some amazing marketing and sign-up bonuses, you're probably going to get scammed. And they're probably going to be trading against you. And they're probably going to have really wide spreads. And you're probably going to lose your money. But if instead you go for a broker that's regulated in a major first-tier market, think US, Australia, Canada, UK, not Cyprus or Isle of Man, some tax haven or something, some dodgy place you've never heard of, go for a major broker. It's got to be safe. Second consideration is cost. You don't want to be paying for lots of bells and whistles. You need good execution, cheap. Because if you're going to be placing lots of trades, it makes a huge difference if you're paying $20 a trade compared to $10 a trade. It can add up to thousands over a year. So cheap. Next thing is, I really think it's important that you are not trading against your broker. Some brokers, they're more like bucket shops. If you've read, any of the old trading books, it's like you're not really trading on the exchange. It's more like some of the CFD providers, for example, contracts for difference. You are not in the real market. They make a market for you based on the prices in the real market. That's a terrible way to trade because it's in their incentive to screw you. So I want my trades to be placed in the exchange with the other participants. The broker should facilitate that, not trade against me. And I think those are the important things.
I see. That's great advice. All right, so Adrian, I don't have a lot of time, but before we end off today's session, I want to get you to share a little bit about your current lifestyle as a system trader. I'm pretty sure that although you mentioned that you are currently only spending 30 minutes a day on executing your systematic trading strategy, but I'm sure you actually spend more time on trading related activities on top of that 30 minutes. So can you share a little bit about, let's say, your daily lifestyle? How is it like, and what are the additional things that you spend on trading, and how about your personal time, family time? How do you actually go about managing your entire day, or let's say over the course of 1 week or a month and stuff like that?
Sure. Look, right now I'm in Australia and I'm based in one place. In the past, like in 2019, I traveled for the entire year. We took our kids out of school and we spent 3 months in the US, 3 months in Europe, and the rest of the year in Asia. And I just did my trading as we traveled. And so that year, trading was really 30 minutes a day because we had better things to do, to be honest. The process for that is at the right, when the market data from today becomes available, which is usually a couple of hours after the close, you update your data, you check your existing positions for exit signals, you run your explorations or scans for new open trades, and you place those trades with your broker. And then that's job done. So that's the bare minimum. That's the 20 to 30 minutes. On top of that, trading related activities tends to be, developing new systems, testing ideas, thinking about different ways you can diversify and improve the portfolio. For me, a lot of my time is spent teaching because I like to talk to traders, and I find a huge kind of joy, fun, satisfaction in taking someone who is losing money and putting these things in place that I talked about today. And then a couple of weeks later, they're trading profitably. That is just astronomically cool, because if I can turn someone's trading around and then they grow and they have a 10, 15, 20-year trading career, think how much value that creates. I mean, that's huge, right? It's not just me then, that's other people. So that's why I like to deal with other traders. It's really, really cool. But my day now, because I'm in Sydney, I'm not in Sydney, I'm in Australia, and we're not traveling. We wake up, we send the kids off to school, I update my data, I place my trades. Then typically I've got coaching calls and I teach. My wife and I hang out, we go out for lunch, we'll go for a walk on the beach, have breakfast, all of that. So it's kind of like however I want to spend my day. I have Mondays and Fridays where I do no meetings at all, no teaching. So typically those days we just like a extended weekend. And then my kids come home from school, they get home on the bus, and I'm always here every day when they get home. So they walk in, they walk past my door, we hang out and talk to them, help with homework, blah, blah, all the usual stuff. And that's it, so I can fill my day with teaching and trading in that respect, but I don't fill my day with actual trading, as in executing buys and sells. That is really literally a very small slice.
I see. And how about things like testing out new strategies? Because some systems trader that I know seems to actually go down this rabbit hole of constantly trying to think of new ways or new strategies to test. So is that something that affects you as well? And what's your suggestion on finding a balance between going down this rabbit hole and on other aspect, thinking that these few strategies that you have is going to last you for the rest of your life and there's nothing else that you need to do? So how do you actually go about finding a balance on that?
Yeah, it's definitely a balance. One or the other doesn't help, right? Because if you just constantly test, you get stale and you run out of ideas. But if you just assume your systems are going to last forever, you're delusional, right? They don't. Eventually, they will decay. Interestingly, trend following decays far more slowly than anything else. So if you wanted to just be the more lazy type, let's say, have a couple of systems in place and just trade, do trend following. Don't do very short-term trading because they decay quickly. But I would say have a process of capturing ideas to improve your systems, which is separate from the systems you trade. So I have my systems which are in production. I trade them. I don't change them daily, weekly, monthly, or probably even 6 monthly. But I have a whole list of ideas that I want to try out. And if I take this idea and I add it to the system and it works, I might then firm up that idea and then put the change into production and then trade the production system. But the rabbit hole is a problem when it prevents you from actually trading. Test. I've got to make the system better. Got to find a better system. Got to find better rules, blah, 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 blah. But you're not actually trading. You get to a point where these rules are okay. They're good enough. Start. Then follow those rules, play with ideas separately. That's the most important thing.
Fantastic advice. Hey, Adrian, this has been a really fruitful session for me, and I'm sure the summit participants benefited greatly from your sharing as well. So thanks again so much for your participation in the summit.
Philip, thanks so much for having me. It's an absolute pleasure. I love being part of all of your programs, and I'm really excited to hear everyone else's presentations as well. Thank you so much.
Fantastic, my pleasure. Now, for those of you watching this summit video right now, if you would like to keep in touch with Adrian and remember, receive from him a very comprehensive free trader acceleration bundle that includes things like videos, tools, courses, and cheat sheets to put you on a path to a good start to a systematic trading, remember to click on the web link provided below this summit video to learn more. And finally, if you would like to review Adrian's summit video beyond this summit, or to watch more of Adrian's recordings from our previous summits, you can also check out our TraderWave TV service, which is in short, the Netflix for trading education. Now, with that, we have come to the end of this presentation and Q&A. I'm your summit host, Philip Teo, and I hope you will continue to learn and apply the teachings from the many wonderful speakers on board this virtual summit. Take care, and we talk soon.